Good evening and welcome to the Capital Market. I'm Edidiong Iwang. Well, the first trading week of the new year 2020 ended on Friday in spite of heavy-hitting headlines from the global economy. Well, let's begin the show with a review of trading activities and some market headlines. Well, Broad Street opened for 4 trading days this week, as Wednesday, January the 1st, was a public holiday to mark the New Year calendar. The NSE All-Share Index and market value jumped by 2.09% to close the week at 26,968.79 and 13.01 trillion naira respectively. A total turnover of 2.3 billion shares worth 21.67 billion naira in 14,906 deals were traded by investors. Now, this was in sharp contrast to a weaker turnover volume of 735.7 million shares worth 17.13 billion naira traded in the Christmas and Boxing Day week. The 5 key sectors we track ended the week positive, with oil and gas gaining the most by 5.41%. Insurance added 4.58% on the news of the sector's recapitalization extension, while the banks finished 2.95% better. Consumer and industrial goods were up by 0.78% and 0.29% each. Now moving to fixed income, Naira bonds closed on a positive note on Friday as average yield was softer by 22 basis points across the curve. Average yield declined to 8.18%. And in Treasury bills, the market also ended positive on Friday. Buying interest was witnessed across the short and medium tenor of the yield curve on sustained market liquidity. Average yields across the curve declined by 5 basis points to 10.08%. And for the CBN open market operations, a total of 73 deals worth 119.48 billion naira were traded at the secondary window on Friday. And this was following Thursday's first OMO auction for the year, in which 74 billion naira was sold with lower stop rates offered by the financial regulator. Well, the first treasuries auction by the central bank in the new year 2020 was oversubscribed by 100 billion naira on Thursday. The regulator sold 74 billion naira worth of 3 dated instruments at stop rates of 3.50%, 4.90% and 5.2% at the auction. The Treasury Coverage Officer at Axis Bank told Channels Television on Friday that the yield curve on T-bills may start to rise as market liquidity taper off around mid-year. Well, Lagos State Government this week opened Series 3 of up to 100 billion naira under its 500 billion bond issuance program, looking to increase fiscal and social infrastructure. The offer, which closes on January the 13th, is backed by the State Irrevocable Standing Payment Order and the Consolidated Debt Service Revenue funded from its internally generated revenue. Lagos is floating the 100 billion naira debt for a 10-year period at an indicative coupon rate of between 11.75% and 12.25%. Well, big news for insurance sector regulator as NICOM extends the recapitalization deadline for insurance. The earlier deadline of June 30th, 2020 was moved to December 31st this year. On Monday, NICOM announced that the central bank has obliged the Commission with the opening of a recapitalization escrow account for the deposit of fresh funds raised by insurance firms for recapitalization. Well, as the new year begins, analysts have been presenting their outlook for various asset classes, including equities. Well, the head of research at United Capital, Wale Olusi, says if some concerns, such as flight of foreign portfolio investments, are addressed, the market could grow by as much as 23% this year. Wale Olusi was speaking in an extensive interview with Channel's business editor, Bosin Omofaye, on our Business Morning program during the week. Let's take a listen.
If you now look at the fact that domestics can, buy some of these stocks who have high dividend yields, and in fact there's a lot of liquidity in the system, hopefully that might push the market up about 5%. Because what we've seen over the years is that the FPIs are actually the biggest drivers of performance in the Nigerian equities market, and we saw that in 2017 after the I&E window was opened. Again, on a technical basis, we realize that a bearish note, the market can actually go lower, about 10% or 16% negative, if things go from where they are now to really bad. But it can improve if some of the concerns are adjusted, and it can go as high as 23, 25%. If some of these things are adjusted. The key concern, again, are the fact that FPIs are not looking at equities at the moment. Some of the policies may affect the tier 1 banks, especially because some of the policies that we have seen around, non-interest income, as well as the fact that the CBN wants the banks to lend a lot, may affect the performance of some of these listed stocks in 2020. So those are the key issues that is keeping our outlook very, very modest at about 5%.
There's so much liquidity in the system, Wale. So it's very amazing that there's huge liquidity, almost £1 trillion on the last day of 2019 from the central bank. So why is this money finding it very difficult to get into the stock market for a big jump, considering even if these go into the dividend-paying, very good companies with dividend payouts and dividend yield companies and all of that? What is the key issue here for both local and foreign investors? Even as yield continue to go towards single digits at the fixed end of the market, yet the money is not flowing into the stock market. What's the message here?
I think that's a great question, Borsin. I think it's a great question. Now, let me talk to the first point you mentioned. The first question you mentioned about liquidity of about $1 trillion that came in last week or earlier in the week. What we noticed was the fact that the CBN actually debited the banks. Almost the entire thing was taken out of the system through, the LDR debit. The second reason is that what we also noticed from studies is that, yes, system liquidity have a positive impact on demand for equities, but that only happens if the surge in liquidity is unexpected. Once the surge is expected, it's almost like people start looking at elsewhere. Besides, there are concerns around, the risk in the equities market. So the biggest buyers in the local market, the PFAs, the fund managers, the insurance companies, it looks like they are more comfortable buying zero-risk government instruments, as well as the fact that corporate papers are getting very, very interesting. And I think that's the message. Riskier assets such as, the sub-national bond that the, Lagos state government is currently running, a number of commercial papers that are already in the market, and there's so many of them that will, be out in 2020 are going to be much more attractive than, the sovereign instrument, and we think many of this liquidity will be going into them. The balance, perhaps, will go into equities if people want to take advantage of the, attractive yield when they declare their dividends.
So, where are the sectors that you're looking at as for high-quality dividend yield, paying stocks or sectors in the new year 2020? What's the playbook?
Well, broadly speaking, we are looking at the agri sector, Presco and Okomo. We think those two stocks are great for 2020, basically because of what is happening around the border and the fact that it will impact on their performance positively. And they do good dividends too. For dividend, high-quality dividend-paying stocks, we think the likes of Tier 1 banks, even though they will be pressured, but if their prices go lower, their dividend yields, become more attractive. The Tier 1 banks specifically, are our top picks for good dividend. Some of the beer companies also pay good dividend, as well as Nestle in the consumer goods space. And then cement, the cement players, the big guys there, the Dangote Cement, the WAPCO, also pay good dividend. We have an old rating on WAPCO, but we think Dangote Cement is very, very good at current price. Plus the corporate action that is currently ongoing, we think it makes them even much more attractive because 1.7 billion units of shares is a huge demand that might drive up the price.
The Nigerian Stock Exchange started the new year with the result on the review of the basket of indices, leading to the entry and exit of some companies effective January the 2nd. The indices, which are rebalanced on a semi-annual basis on the first business day in January and later in July, were developed to allow investors follow market movements and properly manage investment portfolios. Abiodun Keripe is the head of investment research at AfriInvest Securities, and he provided a drill down on the latest review a day after it was released this week. Let's listen.
The level of expression of confidence on the stocks or the constituent of the index. So it then means that a retail investors can close their eyes and have confidence to buy into the constituent on that index or to buy into the entire index as a whole. It reduces the level of effort, the level of work that has to be done in terms of or in form of research or in form of fact finding to sort of know if you're investing in an index that is sound, that is strong, and because you know you have someone, a manager somewhere that is monitoring the performance of the index, monitoring the performance of the constituent, it gives a level of confidence to the investors. This is why it is very important.
Great. So if we look at what was released yesterday, the consumer goods, the banking, the NSE, oil and gas were not rebalanced in any way. What does this say about, in particular, the first two, the industrials and the consumer goods, sorry, I beg your pardon, the consumer and the banking index?
So it wasn't like they were not rebalanced. They were rebalanced. However, that means that the constituent still meets the criteria for selection or inclusion on that index. So they still meet the criteria for them to remain on the index. So at the end of the day, there was no exiting or new incoming constituent on the index. This is the implication. This is what it means. Unlike what you see happen to the NSE 30 index, where you have new names such as MTN joining the index, it means that MTN, after its listing early 2019, has met the criteria for inclusion on that index. I mean, we both know MTN competes fairly well with Dangote in terms of the most heavyweight stock on the Nigerian equity market as we speak.
So, yes, that's why we're drilling down a bit on MTN here as the new poster boy for the Nigerian market. Because out of what was released yesterday by the exchange, it went into the NSE 30, the pension index, the corporate governance index, and I think one other index. So it means that investors can begin to take a second look at MTN. What's your thoughts at AfriInvest on this particular company with this inclusion in a number of markets indices?
So we think here that MTN deserves it as long as it met the criteria for inclusion or selection. It's either the first or the second most capitalized stock on the stock exchange. In terms of corporate governance, you could rely on the structure of corporate governance within the MTN group. And then in terms of its ability to pay dividend, pay income, which is critical for it to have been included on the NSE pension index, it also meets this criteria. So we clearly think and believe that this is the right thing to have been done as long as the stock met the criteria for inclusion on those three indices.
Why is the corporate governance index inclusion of MTN very important? That's a very specific and totally a bit different index among all the others.
Why this is important is, why this is important is speaking to the broader picture of what corporate governance means. It means that you have a management that is put in place structures to properly run a business, to ensure that there are no leakages, to ensure there are no excesses, to ensure that the business is well run, to ensure that the management meets as a when due, as a when expected, to take critical decisions that affect the business, that affect the day-to-day functioning of the business, that affect the long-term planning or the long-term, achieving the long-term objective of that business. So this is why this is important. This is the implication of it having a good corporate governance structure, and it is one of the variable that a lot of other companies, that operates in Nigeria, need to also copy, need to also imbibe into their culture.
When we return from the break, we'll take a look at headlines from cement makers in the country. Stay with us. Well, thanks for staying with us on the program. Dangote Cement has announced plans to buy back 10% of the current entire issued shares in order to improve shareholders' value and facilitate the company's long-term growth. The cement giant also announced the retirement of its group managing director and CEO, Joseph Makoju, effective January 31st, while notifying the market of the onboarding of the new group CEO effective February 1st. Well, a capital market analyst, Rotimi Fakayo, spoke on Dangote Cement's moves and other cement makers in the news on our Business Morning show this week.
I believe it's going to be a plus for Dangote Cement because over the years they've really trended well. And I think this position will actually also increase their market share because what they know how to do best in Lafarge WAPCO will also be, the new CEO will be bringing it along to join what Dangote Cement is already doing. So I believe it's going to be a very big plus for Dangote Cement, and I think it's a time to make a good choice of buying that stock, Dangote Cement. More so for the share buyback.
If we stay with the Rotimi, just a quick one before we go to the share buyback or shares repurchase program. If we stay just about a minute with the change of leadership here, if you look at Makoju's tenure as the group managing director of Dangote Cement, what would you consider some of his footprints? This is one big individual in the cement business, Nigeria's business cement history. If you look at that, it was a two-time, it was a minister of power and all of that. So when we say Joseph Makoju in Nigeria's business and what he did for Dangote over the last 5-10 years.
Yes, I think if we look at the trend in Dangote Cement, we see that it has actually had a lot of growth. And that growth has been majorly organic due to what Mr. Makoju has put on the table, coupled with the ideas that the chairman, Alhaji Dangote himself, has. And I think every investor of Dangote Cement are quite happy with what has happened over the years. And though it may be a big vacuum, but I want to believe strongly that they may not let him go fully. He may still remain on the board so as to at least continue to give what he knows how best to give. And I think with the CEO of Lafarge Africa coming in as the CEO of Dangote Cement, I don't think there is going to be any gap at all. And I think whatever vacuum that is going to be, definitely with time we're going to see it filled back, and we are definitely going to see a better and stronger Dangote Cement.
Dangote Cement has expanded from just being a Nigerian cement company to being a Pan-African company doing business in about 14 African countries, and it doesn't look like it's stopping anytime soon with what is in the news, what the company is trying to do in Cameroon and in Togo as well, and has even expanded outside the cement business. So if you look at the construction sector, do you think getting someone in from Lafarge Africa, who is a major competitor to Dangote Cement, to cross over into Dangote Cement will raise the game for Dangote Cement in terms of the market share that it currently holds in the Nigerian space?
Presently, I believe the market share of Dangote Cement is in the neighborhood of 60 to 65%. And that is quite huge. And anything that we add to that will make them a major domineering factor in that industry. And I think with what is coming up right now, there is no way Lafarge Africa will not lose market share to Dangote Cement. And I believe that strongly. And that definitely will go a very long way for Dangote Cement. Not just a Nigerian player, but also a global player, because it's also extending its territory beyond Africa continent. And I think definitely we will see a stronger, more viable, more profitable, and sustainable company in Dangote Cement Company as time goes on.
Okay. Well said. But let's talk about the share buyback. I'm sure when it comes to share buyback, that goes to cash on hand, I'm sure, for you folks who are holders of Dangote Cement shares or who trade on behalf of clients.
Yes, I think for the share buyback program, which is going to start, I believe there has been a lot of transparency concerning it, no shady deals, everything being thrown open, even as they have not started. The news have been around, and the news was confirmed when it hit town, and the processes are started, although the program itself has not commenced. I believe that definitely this would mean a better company at the end of the day for investors. Because, for instance, the price of a company is largely defined with what we have seen in the Nigerian foray, even outside, by the number of shares and also the number of shares in issue. Take, for instance, Dangote has 17 billion shares and the price is trending at 140. Nestle has 792 million shares, less than a billion, and the price is trending at over 1,400. So there is a close relationship also with the earnings per share. So I believe it's going to be a big plus for Dangote Cement by the time they do the share buyback and also the reconstruction of their shares. If we go outside the coast of Nigeria, if you look at a company like Microsoft in US, the number of shares in issue is about 7.71 billion shares. Whereas for Alphabet, Google, is about it's 792 million shares. And the price of Alphabet is close to $2,000, about $1,850. Whereas that of Microsoft is just a little above $148. So there is a close relationship between price of the shares and also the number of shares in issue. Dangote Cement has taken this into consideration, and they believe that there should be a better pricing for their shares. By the time they are done with the share buyback and also the reconstruction, we are definitely going to see a Dangote Cement company that will be the delight of every investor.
Does it give comfort to analysts and investors and shareholders? Dangote Cement says, look, we're going to finance this share buyback from our reserves. So I look at the retained earnings for Dangote Cement, close to 800 billion naira. So for this share reconstruction of just about 1.704 billion naira, taking that from the reserves and funding it with the existing cash, what does that mean about the ability of this company to buy back its own shares with its existing money rather than depending on the cash flow that the company is doing? It makes sense here. So folks are asking questions about what would be the likely earnings per share, what would be the likely price on the market, what would be the likely dividend yield moving forward?
Well, I think this is what the company is actually very much concerned about. And it's going to be a very big plus for the investors at the end of the day. Going further on that, by the time not everyone is going to participate in the share buyback, they're going to see a lot of good future in the company. So a lot of people will withhold, but it is only those shares that are free floating that actually cause fluctuation in prices that will actually be sucked up by this process. And the cost of this, I don't think the entire 1.7 billion shares will actually be taken back, and we may not even see more than 20% of that being taken back. And by the time that is done, we're going to see a share reconstruction following suit. And by the time that is achieved, we may see an earnings per share of Dangote Cement tending towards 50 naira per share, depending on the construction ratio.
Well, that's it on the program tonight. Thank you for watching. I'm Edidi Ongiwang. See you next time.